Contingently issuable shares. An agreement that specifies additional shares of common stock will be issued contingent on the occurrence of some future circumstance. The best example is there is a target of net income. So if we can meet or beat that net income target, if we can issue more shares. If we cannot, we will not issue more shares. So that is the example for contingently issuable shares. Contingent shares can be issuable to shareholders of an acquired company, certain key executives, or others in the event a certain level of performance is achieved. Contingent performance may be a desired level of income, a target stock price, or some other measurable activity level. It is considered to be outstanding in the computation of diluted earnings per share if the target performance level already is being met. For example, if shares will be issued at a future date if a certain level of income is achieved and that level of income or more was already reported this year, so the additional shares are added to the denominator of the diluted earnings per share fraction. If the target income next year is $150 million, let's see the example. Sovereign Financial Corporation reported net income of $154 million in 24, tax rate 25%. Assume 3 million additional shares will become issuable to certain executives in the following year, 25, if net income that year is $150 million or more. Assumed issuance of contingently issuable shares, diluted earnings per share. 154 million is greater than 150 million, so we have to add the 3 million additional shares into the denominator. In contrast, if net income that year is $160 million or more, so $150 million is less than $160 million. Therefore, the contingent shares are ignored. Actual conversions. Diluted earnings per share of convertible bonds that were converted during the year would be precisely the same as if not converted. Calculation of diluted earnings per share. If it's actual conversion, this would cause an actual increase in shares from the date the convertible bonds are converted. This will be time-weighted, so the denominator would increase by the fraction. The numerator would be higher because net income actually would be increased by the after-tax interest saved on the bonds. Assume conversion for the period before conversion, before they were potentially dilutive during that period. If the company has convertible bonds, 8%, $300 million face amount issued in 23, convertible into 12 million common shares on November 1st. If not actually converted, we need to add back the interest expense to the net income. So this is 24, which is the interest, and minus the 25% times the interest expense. So this is net interest expense. We need to add it back to the net income. In the meantime, the denominator will increase by 12 million common shares. So we can see it is 18 divided by 12. This is the net effect of assumed after-tax interest savings if converted on November 1st. So we can see first we need to count actual after-tax interest savings following conversion. So this will be weighted by 2 over 12 months because that is converted on November 1st, so November and December. And also the denominator will be increased by the weighted average as well, which is 12 times 2 over 12. And we still need to count the assumed after-tax interest savings before conversion, but now it's not 12 months, it's just 10 months from January to October. So everything near to times 10/12. Financial statement presentation of earnings per share data. Basic earnings per share and diluted earnings per share must be reported separately for income from continuing operations and net income when the income statement includes discontinued operations. Per share amounts for discontinued operations will be disclosed either on the face of the income statement or in the notes to financial statements. For all reporting periods presented in the comparative statements, business without potential common shares present basic earnings per share only. Let's see the earnings per share disclosure of H&R Block. It's on the consolidated income statements for the years ended April 30, 19 and 18. The company reported both basic earnings per share and diluted earnings per share. Disclosure notes should provide additional disclosures, including a reconciliation of the numerator and denominator used in the basic earnings per share computations to the numerator and denominator used in the diluted earnings per share computations. Any adjustment to the numerator for preferred dividends, any potential common shares that were not included because they were anti-dilutive, and any transactions that occurred after the end of the most recent period that would materially affect earnings per share. Option pricing theory. Option values have two essential components, the intrinsic value and the time value. The benefit the holder of an option was realized by exercising the option rather than buying the underlying stock directly is intrinsic value. An option that has an exercise price equal to or exceeding the market price of the underlying stock has zero intrinsic value. Okay, now let's talk about time value. Options also have a time value due to the fact that the holder of an option does not have to pay the exercise price until the option is exercised. The market price of the underlying stock may yet rise and create additional intrinsic value. The longer the time until expiration, other things being equal, the greater the time value. Subdivided into two components, the effects of time value of money and the volatility value. So what's volatility value? One popular option pricing model is the Black-Scholes model, which assumes a log-normal distribution. This assumption posits that the stock price is as likely to fall by half as it is to double, and that large price movements are less likely than small price movements. The higher a stock's volatility, the higher the probability of a larger increase or decrease in market price. The effect of variables on an option's fair value. This is very finance, alright? So all other factors being equal, if the exercise price is higher, then the option value will be lower. If the term of the option is longer, the option value will be higher. If market price of the stock is higher, the option value will be higher. If dividends are higher, the option value will be lower. If risk-free rate of return is higher, the option value will be higher. If the volatility of the stock is higher, the option value will be higher. Stock appreciation rights. Stock appreciation rights enable an employee to benefit by the amount that the market price of the company's stock rises without having to buy shares. Employees are awarded the share appreciation. Share appreciation, the amount by which the market price on the exercise date exceeds a specified price, usually the market price at the date of grant. It is usually payable in cash or in the recipient has the choice between cash and shares. So for example, if the share price rises from 35 to 50, the employee receives the difference, which is 50 minus 35, $15 cash for each stock appreciation rights held. So this is stock appreciation rights of IBM Corporation. So is it debt or is it equity? The accounting treatment depends on whether the award is considered an equity instrument or a liability. If the employer can elect to settle in shares of stock rather than cash, the award is considered to be equity. If the employee will receive cash or can elect to receive cash, the award is considered to be a liability. SaaS payable in shares. The fair value of the SaaS is estimated at the grant date and we accrue that compensation to expense of the service period. The cash settlement of an equity award is treated like the repurchase of an equity instrument. The total compensation is not revised for subsequent changes in the price of the underlying stock. SaaS payable in cash. The fair value of the SaaS is estimated and that amount is recognized as compensation expense over the requisite service period. The fair value is periodically reestimated in order to continually adjust the liability and the corresponding compensation until it is paid. The periodic expense is the fraction of the total compensation earned to date by recipients of the SaaS reduced by any amounts expensed in prior periods. Example: at January 1st, 2024, Universal Communications issued the SaaS that upon exercise entitle key executives to receive compensation equal in value to the excess of the market price at exercise over the share price at the date of grant. The SaaS vest at the end of 27 cannot be exercised until then, and expire at the end of 31. The fair value of the SaaS estimated by an appropriate option pricing model is $8 per SaaS at January 1st, 24. The fair value re-estimated at December 31st, 24, 25, 26, 27, and 28 is $8, $40, $8, $6, $4.30, and $5 respectively. Case 1. SaaS considered to be equity because Universal can elect to settle in shares of Universal stock at exercise. So on January 1st, 24, there is no entry, but we need to calculate total compensation expense of SaaS. Estimated fair value per SaaS is $8. Assume SaaS granted is $10 million, so the total compensation will be $80 million. The total compensation is allocated to expense over the 4-year service period. So 80 million divided by 4, each year the compensation expense will be $20 million. So the journal entry for the end of the year for 24, 25, 26, 27 will be debit compensation expense $20 million and the credit paid in capital SpicelandCh $20 million. Case 2. SaaS considered to be a liability because employees can elect to receive cash at exercise. January 1st, 24, still no entry. The end of 24, the journal entry will be debit compensation expense, but the amount is the fair value in that year, in the end of that year is 8.40 times 10 million SaaS times, this is 1 out of 4 years because it's vast at the end of 27, so it's 24, 25, 26, and 27, 4 years. Now only 1 year is passed, so it is 1 out of 4. So for that year, debit compensation expense 21 million and the credit liability subplan 21 million. Second year, December 31st, 25, compensation expense will be 8. 8 is the fair value on December 31st, 25. All right, that year, 8 times 10 million SARS times, this is 2 years past, now it's 2 over 4, and minus the 21 million recognized in 24, last year recognized in the first year. So for the second year, compensation expense will be the difference, 19, liability credit by 19. So the year, December 31st, 26, now the fair value for December 31st, 26 is $6. So 6 times 10 million SARS times, this is 3 years accumulated. So it's 3 over 4 minus 21 recognized in 24 and 19 recognized in 25. So this year compensation expense will be debited 5 million and the liability will be credited by 5 millions. So last year, 27. Now it's very interesting. 27, the fair value is 4.30 times 10 million SARS times accumulative is 4 over 4 minus 21 recognized in 24, 25, and 26. We found it's negative 2. It's negative 2. What does that mean? It means we have to reverse what we recognized in previous years. So compensation expense this time is reduced by 2 because it's negative 2, and the liability is also reduced by 2 in 27. Compensation expense and the liability continue to be adjusted until the SARS expire or are exercised. So we will continue to adjust it on December 31st, 28. We can see that the fair value for December 31st, 28 is $5 per share. So 5 times 10 million times all means 1, okay? Minus 21 recognized in 24, 25, 26, and 27. 27 is negative, so minus the negative 2 equals plus 2. And then we get the compensation expense for that year equals 7. So debit compensation expense 7 million and the liability credit by 7 million. Assume that the SARS are exercised on October 11, 29 when their fair value is 4.50 and executives choose to receive the market price appreciation wash in cash. So first we need to calculate the compensation expense for that year, 29. It's 4.50. So 4.50 times 10 million times 1 minus 50. This is, where is this 50 from? Let me write it. It's 21 in 24, 19, 5, 2 minus 2. This should be minus 2 and plus 7, right? Plus 7. So it equals 50. So this is how we get the number. So minus the recognized amount in previous years. So the liability this year will be negative 5. Therefore, the compensation expense is debited, reduced by 5, and the liability reduced by 5. And don't forget to recognize the exercise. The exercise will be paid in cash, so cash is reduced by 45, which is 4.5 times 10 million shares, and the liability reduced by 45. So this is the T account. In 24 it increased, 21, 25 is increased by 19, 26 increased by 5, and the 27 reduced by 2. 28 increased by 7, and 29 reduced by 5. And 29 is exercised, so debit 45 and get a zero balance after that. Restricted stock units payable in cash. Sometimes the recipient is given the cash equivalent of shares instead of the shares. If the employee will receive cash or can elect to receive cash, the award is considered to be a liability and accounted for the same as an SR payable in cash. Its fair value is determined at the grant date, and that amount is recognized as compensation expense over the requisite service period. The liability is periodically adjusted based on the change in the stock's fair value until the liability is paid. Alright, that's all for Chapter 19. Feel free to send me email if you have any questions. Thank you.